Alright, hello everyone, this is Emil. Welcome back to the channel. If I look different, yeah, I shaved my head because I'm out of work at the moment because of the coronavirus. So I thought, why not? There's no other opportunity really, and I always wanted to see what it would look like. So with that out of the way, let's get straight into the video. So in today's video, I wanted to talk about 3 different reasons why I believe right now is the best time for you to start investing if you haven't started investing. So 2 of the 3 reasons I believe that you should, if you haven't started investing, that you should start investing right now are evergreen reasons, meaning that they're always relevant no matter what the market is doing. So I believe that right now, whatever we are, whatever time it actually is always a good time to be investing no matter what's happening in the market. Okay, so the first reason I believe that you should start investing right now is that actually just learn as much as possible as early as possible. So it doesn't matter what's happening in the market. If you haven't started investing, you haven't dealt with the emotions that accompany investing. When I started investing in cryptocurrency. So you can imagine the emotions with that were pretty intense, to say the least. I made a fortune on paper and I lost a fortune on paper. So that was a nice quick wake up call, got me straight into the craziness of investing. And although actually it was a considerable amount of money for me, if I had started doing that and at maybe 30 years old, it might have been an even more considerable amount of money. So if you're investing right now, chances are you'll have less money than less disposable income than you might in 10 years. So that's another reason why I believe investing right now when you have smaller amounts of money to waste, because your first couple of years investing are unlikely to be, unless you're very lucky, your first couple of years investing will likely not be fantastic. You won't make a fortune. It's kind of a learning process to learn, okay, anytime I rely on my emotions too heavily, I usually get burned. And it's you kind of learn the ways of being contrarian to the market and investing when other people are scared, and not buying when other people are buying, or when other people are greedy. So yeah, if you're younger as well, you're less likely to need that money as much. If you wait until you're 30 years old or even 28 years old, when you have I'm 24 at the moment, I'm still living at home, so I pay rent, but I don't pay. If I'm completely broke, maybe my mum would let me off the rent or let me pay late. There's not so much responsibility when you're young. But if you're 30 and you have 2 kids, like, that really matters, that you're not losing money. So you're not going to be, if you hadn't have learned those principles in the beginning, you might not be so, might be too cautious with your money, or you might make some emotional decisions because you can't take losing any more money, so you sell at a loss and then the market bounces straight back up. Yeah, another reason is if you start reading books and start watching YouTube videos about investing at a younger age, and start learning how to actually research your own companies and how to analyze a balance sheet and analyze a company's future growth potential. If you do that at a younger age, you're going, like, say I started 20 years old. I'm not great. I don't beat the market. I get a 6% return because I'm a newbie. I'm not very good at researching companies and haven't really mastered my logical brain when it comes to investing yet. I could expect a 6% return, and by the time I'm 30, now I'm averaging a 10% return after everything I've learned. But that's much better than if you start at 30, you only get a 6% return, and then by the time you're 40, that's only when you're getting the 10% return. Imagine you have the 10% return from when you're 30 to 40 as opposed to the 6%. That's not a double up in return. That's much more than a double up. It might be a double up in percentage, the interest that you get, but it's not a double up in the amount of money that you finish with, because it's exponential, so you're going to end up with a lot more money by having a few more percentage points. Okay, let's move on to the second reason why I believe you should start investing right now. And the second reason is probably the more obvious reason. When you clicked onto this video, you're probably like, okay, if I'm watching this right now, it's the coronavirus, and that has brought the entire stock market down. And if you haven't started investing and you're planning on becoming a long-term investor, which you probably should, 99% of people should become long-term investors. If you're buying good quality stocks that will survive the coronavirus, recession, or bear market, whichever we're in, if you buy those stocks in 10 years, they will be worth more if they survive. They're good stocks. So we're buying at a nice dip. It could be a severe dip, it might dip further, but at least you're not buying at the very top of a market right now, this very moment in time. Although I think this reason is one of the lesser important reasons of the three. So yeah, we're buying at a dip, that's always great. And just to add to that point, buying when other people are, like, there's max fear in the market right now. No one's sure what's going to happen in the economy. So if you're learning to invest during those kind of times, that's a really good thing to be able to learn to be greedy when other people are fearful, and to learn to be able to cope. Because if I invest right now, there's a good chance my investment might fall further. But it's being able to invest when a stock market is sliding or a stock is going down, because that's usually a good time to invest. You might not catch the very bottom, but at least you won't miss out on the potential great gain when the stock does finally recover. Okay, finally we're moving on to our final reason, and possibly, if not probably, the most important reason why you should invest in the stock market right now, and that is because time in the market always beats timing the market. Now, you might have heard that phrase before, but basically what it means is that people who buy the market no matter what price it is and don't sell it until 20 years later almost always be people who try and wait till there's a nice entry point and the stock market dips. It's a bad entry point because it dips further, and they sell after it's dipped because they think it'll dip even further. Then it goes back up, so they buy back in. It's very, very hard to time the market, and there's not one billionaire or multi-millionaire who's done it successfully, consistently. It's much easier and much more rewarding in the fact, like monetarily rewarding. You just buy the market. Doesn't matter what happens, just keep buying consistently through everything. Don't sell, and then once you need the money in 20 years, then you can start selling it. Okay, now coming up on your screen is a little graph. So this shows a $10,000 investment over 40 years, and this person, the person who has the 700,000 on the left, just bought in January 1st, 1980 and never did anything with it. The person who missed 5 days out of the 40 years, the 5 best days in the stock market, has reduced their return by 250,000. And the person who's missed the top 10 best days in the stock market because they sold at whatever stages and bought back in to miss those 10 best days have halved the return that they got in the end. So basically, the worst time to sell usually is just after a big correction, because usually the best days in the stock market follow the worst days in the stock market. And we've seen that in the last few days with the coronavirus, where the Dow has dropped by like 10,000 points in a month, but there's been like 10% corrections in a day, in one single day, and then following there's been 6% rises, which are crazy in comparison to normal days in the stock market. So it's a really volatile time. So in a bear market, the worst thing you can do is start selling, unless you're really, really skilled, and I doubt you are if you're just starting, and most people aren't, myself included. Even Warren Buffett wouldn't sell during these kind of things. during these kind of times. Another last couple of reasons why the time in the market beats the timing in the market is because if you're constantly trying to time the market, you're incurring fees, unless you're using like a Robinhood or something. But even then, your Robinhood is feeless, but actually you're paying for the spread. So the price that you sell your stock isn't the price that the person who buys it from you pays for it, because there's a little spread, and that's how Robinhood or whatever free platform you're using makes money. So like every time you're buying and selling, you're incurring little fees, and those add up over time. And furthermore, if you're constantly buying and selling, you have to calculate your taxes much more frequently. Whereas if you just buy and hold, just buy a great company, hold that company, or buy an index fund and hold an index fund, it's a lot less headache trying to calculate your taxes and everything, which gives you more time to invest in other companies and research other companies doing more productive things. Okay, so that's everything I wanted to say for that video. I really appreciate it if you could drop me a like. Let me know if you like this form of video. I usually jump into the computer and show you everything. But let me know if you like this kind of standard YouTube video style. That would be much appreciated. And if you have any thoughts, please let me know in the comments. Click subscribe, and I'll catch you all in the next one. Thanks so much. Goodbye.